Americans, and I think that's an important part of what we need to do. We need to deliver broadband to every citizen in this country. I think the pandemic has definitely highlighted, as students and young students have tried to work from home, it has highlighted the lack of technology and the lack of broadband that many of the families.
If you're looking to buy euro, we're placing an order, so basically you can follow our trades and place the order to buy at 1.21, 1.2. Looking to buy at this price. So if you follow our trades, let's see if it will get executed quickly. So any chances in a second? Oh, okay. Just open new position on euro against United States dollar at 121.12.
Pandemic, and so many people are still lacking the infrastructure. So many people are still lacking the connectivity that they need in order to get their work done, make sure that their kids are able to attend class without interruption. Why is that? And what are the obstacles that we still need to remove as a society?
Well, I think there are a couple of issues that exist. One is just pure high-speed connectivity, and there are many areas in our country that the economics alone would never incent some of our communication services providers to actually go build it out, because the ROI on the investment isn't there. And that's where it's going to require, joint funding between the government and the private sector. And I think in some of our inner city areas, it's just an issue of poverty, and it's an issue of the inequality, and people just don't have the technology. Even if they do have high bandwidth available, they may not be able to afford it. They may not have the appropriate devices to actually then connect and experience this virtual learning environment. So it's a number of issues. We know what they are, and we just need to work together to figure out solutions.
What about the regulatory environment that, we saw a very, sometimes very harmonious and sometimes very strained relationship between the previous administration and the tech industry as well as others. How do you expect the regulatory environment to change under President Biden?
Well, first and foremost, I think that the technology industry, we have become a core, backbone element, whether it's the technology we build, whether it's the platform players, have become the foundation for the global economy. Much like the banking system is critical, much like the energy systems are critical, the technology systems are critical for the global economy to operate. And so the notion that it needs to be regulated, to me, is quite obvious. And I think the opportunity with the Biden administration is, I think there's an opportunity for a real candid dialogue, a real open dialogue, and for us to get to some practical regulatory, strategies. I have said in the past, I actually feel, quite sorry for the folks in Washington and in other countries around the world who are trying to keep up with this technology as a side job and actually apply regulation against technology that's moving so rapidly. And I think it's going to require us to spend time together to educate each other and actually work together to come up with the appropriate regulation in today's world. But it definitely needs to happen.
It's hard to look back on 2020 without reflecting on the racial reckoning that we saw across the country in light of the events surrounding George Floyd's death. Cisco was one of the companies that took a real strong stance, talking about the need for real change, talking about systemic racism. How do you take that in a world where there's not even agreement on whether there is systemic racism?
Well, first of all, I think that as CEOs, I don't think we have the option of sitting on the sidelines any longer. I don't think our employees, our constituents, no one's going to allow us to sit out these discussions. And I think it's easy to be out there and be bold when things are going well and things are working in your favor. But when there are complex issues, I think it requires all of us to step up, and it requires us to all be clear when the answer is obvious and when the situation is obvious, we need to, exert leadership. And I would say that 2020 was a year where we needed as much leadership as we could possibly find. And many of my peers and colleagues were out there. We had lots of discussions with each other through venues like the Business Roundtable, where we shared thoughts and ideas about what we were thinking. And we just tried to come together and be a positive force in the midst of a very complex time. And I think that, we did. Now, look, everybody has their own opinions, and certainly social media gives everybody a platform to express their opinions. So you can expect that kind of thing. You can expect some negative comments, but I think that's what leadership's about. Is when it's a tough situation, you stand up for what's right. And when it's just so clear, it doesn't matter what people say. You just have to do the right thing.
And one of the things that you've said in public statements is that, there's a lot more work to be done. Can you talk a little bit about what that work looks like and what is Cisco doing to help make that change come about?
Yes, we have a team of people that have worked really hard on putting together our social justice strategy and the subsequent initiatives that we're going to be driving, the investments we're going to make. It's a group of very energized employees who are going to keep it moving forward, and I meet with them regularly to just get updates and make any decisions that we need to make. And I think that that's what every CEO needs to do. It's no different than an important business project that you would be running inside your company. You're going to stay close to it. You're going to create accountability. You're going to create milestones, and you're going to inspect it. And I think we have to look at this in exactly the same way, and I think that's the way we're doing it, as well as most of my peers are doing it.
I want to get back to your business a little bit and talk about the transformation that Cisco has been undergoing over the last several years, where you're trying to transform your business from being a provider of hardware into one that's much more software and services oriented. Can you talk about the milestones that you've achieved in that effort?
Yeah, Tom, it's a great question. So in 2017, we did an analyst conference, and we set a target of having greater than 50% of our business come from software and services by the end of fiscal 20. And we achieved that. It was 51% at the end of our fiscal year that just ended. And we're currently working through sort of what are the next wave of milestones that we will, take forward to the street. But I think we have made great progress. We had when I became CEO, we had about a $3.3 billion SaaS and subscription software business, and we exited FY20 almost at $11 billion. So we have added to that very significantly. We still build great hardware. These massive 5G networks, where we're working with 30 providers around the world today, they need high-speed, high-performance hardware to run these backbones of these networks. So that's not going away. But to the extent we can solve problems for our customers with software, it's just faster and it's easier. And we're going to continue making the move in that direction. We'll continue adding more and more software assets to our business. But I think that we've made a great deal of progress. We still have a ways to go, but I'm proud of what the teams have done.
So to reach that milestone in 2020, can we talk about what's next? What do you do? What's the next big milestone, and how long before you're ready to start outlining that in your conversations with investors?
Yeah, we're going to look at a whole series of new metrics around a lot of our SaaS businesses in particular. We're going to get more consistent with reporting of metrics like incremental ARR and the real metrics that traditional SaaS and subscription companies would report. We have a great new CFO, and Scott Herron, who joined us from Autodesk. He and I are going to spend several months building out our model, looking at the implications of a lot of the investments that we're making. And I'd say middle of this year, hopefully we'll be prepared to have a broader discussion on that very topic.
Lastly, I want to talk about the 5G rollout. You're a company that provides the services and the hardware to those companies, those providers that are at the forefront of this rollout. There was a lot of hype behind the 5G and the ways that it would change the way we work, the way we play, the way we interact with machines, and the way those machines change our lives. I'd like to hear from you your sense of why for some has the 5G rollout been a disappointment? Why is it not living up to the hype?
Well, I think it's a matter of timing, right? I think that it will live up to the hype, trust me. I think we're just in the early days, and it's going to go through phases. And right now, the big rollout that you see happening right now is for the consumer handset 5G services. And if you just go back to 2007-8, when we had the 4G transition, at the time, you could have said the same thing. And then what happened is once it rolled out, you saw all this innovation. You saw smartphones, you saw new applications being built. Streaming became, a real viable technology. And I think that we're on the very front end of deploying the 5G technology to the consumer. I think our customers will build out 5G enterprise services, and then I think you'll see a lot of innovation follow. We don't know what that's going to look like, but I think the performance, the low latency, and the inherent value that has been hyped, so to speak, about 5G, I think it will come to fruition over the next few years, and we're just in the early days.
This is Tom Giles with Bloomberg News, and I've been speaking with Cisco CEO Chuck Robbins. Chuck, thank you so much for being with us today.
Thank you, Tom.
Hello, my name is Eric Balchunas, and I'm Senior ETF Analyst for Bloomberg Intelligence. And today I'm going to be going over the ETF landscape, which includes mutual funds. Our team covers mostly ETFs, but we also work in the mutual fund industry because a lot of the same companies are issuing both products. So, and I think it's very relevant for my presentation today, which we call the battle for active. We know that ETFs have taken in a ton of money into what we call cheap beta, Vanguard, BlackRock. They clean up. They've taken about 70% of the cash every year, but there's about 30% left over for active. And a lot of bigger legacy mutual fund companies are starting to come in and try to get a piece of the ETF action. And I think that's what the big theme for us is going to be next year. So let me go through some slides here. Last year, ETFs took in about $500 billion, which was a record. We think next year they'll probably pull that off, but they could even go to $600 billion if you consider what we call the big active bump. These would be flows coming in from these big mutual fund companies that are sitting on upwards of $10 trillion. They have a lot of money, but they have organic growth problems. So they may actually bring over some money to get something going in the ETF space, and that could be worth about $100 billion. I'll show you how we get there. First, the problem for active mutual funds is they have no growth. Their assets are fine. They've gone from $3 trillion to $6 trillion over the last 10 years, but that's only because the market's up so much. Flow-wise, they lost $2.3 trillion in outflows. So it's kind of a mirage situationally, and a bear market could really see their assets decline quickly, we think. So right now they're reading the writing on the wall, and they're going into ETFs to try to appeal to younger investors, RIAs, and try to get their strategies in those hands. So one way, one other slide I want to show is just that right now in the equity world, half of the assets are now passive in terms of fund assets. So again, this is part of that idea that at some point you're going to have to sort of move.
Well, put stop on profit for euro, and I'm going to place it at 121.14. Just right here. Never stop loss, right? Okay, let's see how far it will go, and I would have to put my stop on profit even further. It's great, yeah? We'll make the profit. Speak to you later, guys.
We didn't think they would. It's tough to get assets in ETFs. And their active share is interesting. This is something I want to talk about throughout this presentation, is a little higher than it is on the mutual fund side. And we think that's probably smart. That said, their fees are going to make it difficult. A lot of the money goes to funds that are charged less than 20 basis points. So when you're at 40 to 60, it makes it tough. You have to perform. So besides active non-transparent, another way that mutual funds are going to come over is through conversions. They're literally going to just convert a mutual fund into an ETF. The SEC should approve this. DFA has announced the first one. That's going to be $32 billion. It's a tax managed fund. So these investors will go to sleep one night with a mutual fund and they will wake up with an ETF. And there's been 3 or 4 other companies who have followed suit. DFA is a leader, and we think that ultimately 30 plus maybe another 20 billion. So 50, 60 billion could come over in just conversions alone next year. And here's the thing with all the ETF flows generally go to 1 or 2 places, dirt cheap or shiny objects. It's not so much active or passive. It's just those 2 things. Here's the deciles of flows between cheap and expensive and best and worst performing. And you can see upper left obviously is good, but on the far right, if you can crush it, if you can do really well, you can overcome the fee obsession that these advisors have and retail investors. So we try to explain to people that those are the 2 places that flows are going, and they should really design their products accordingly. The middle is the tough spot, and this because portfolios are changing. Most people's portfolios now are barbelled. They have real low-cost, cheap beta as the core, and then they take some chances on the outside. And, of course, they're going to want something very different when they take those chances. We, on the team, frequently refer to it as the hot sauce. We look at ETFs being designed for this pop potential, which we call the hot sauce, so to speak. If you look at all the launches in 2020, the number of holdings they have is shrinking. In other words, they're more and more concentrated so that they can actually have more of a chance to not just beat the index, but really beat it and get some attention. And again, get some of that shine going that is required. At least that's what the flows are showing us. Now, no better example of this shiny object than ARK. ARK has gone from 4 billion to about 44 billion in less than a year. That's a 10-fold increase. I put PIMCO in there, who's no slouch. They have a good ETF business, just so you can see how crazy ARK's rise has been. And ARK is high cost, stock picking, and they're independent. So any one of those 3 things in the ETF world makes your life pretty difficult. They're all 3, and they found success. And they did that because they are shiny objects all over the place. They have a couple ETFs, and all of their strategies seem to be working. Whether it's the main flagship fund or the genomics fund, even the 3D printing ETF is starting to find a little pop lately. So you can see how much these funds are not just beating the S&P and the Qs, but they're lapping them. And that has been the deciding. Now, of course, we know this might not last. The Janus 20 was a big deal 20 years ago. That fell on hard times. We've seen this where these high flyers do come down to earth. And so we're not saying it will last forever. We're just saying that tends to be what attracts flows. Now, DFA is interesting. They're not doing ants. They're going to issue transparent active, but they're also going to do it cheap. And so their active ETFs are 12 to 15 basis points. So again, because they're dirt cheap, we think they have a good chance. And they've already seen some inflows since they launched. And it's interesting, Goldman took this route too with their smart beta. GSLC is 9 basis points. And that has been very good. I think last I checked, it's around the $10 billion mark. So again, if you sell an active brand name active strategy for Vanguard fees, you're probably going to succeed. That's another way to do this. And if not, there's always BYOA, which is bring your own assets. And this is where if you have a network of advisors, or you have some in-house money, or you just have mutual fund investors that you can bring over, this is a look at issuers by their percentage of assets that are in-house or internal assets. And you can see some issuers do it a lot, some not so much. But again, we think maybe upwards of 20 billion could come over next year through this BYOA process. And all this big active, these traditional active managers are coming over, and whatever route they choose to go, organically, they're going to have to fight what we call new active. So new active is using an index, it's rules-based, but it's definitely doing an active strategy. That would be thematics, smart beta, and ESG. All of those are deviating from the benchmark. And you can see that in the last year, smart beta has really lost market share to themes, ESG, and stock picking, namely Cathie Wood, and ARK is that white bar there. And so we think smart beta, which for years dominated this sort of non-beta portion of the pie, is now going to be a much more competitive place. You can see here, this is the pie. This is what everybody's going to be fighting over, because this is where you can actually make some money. That's 25% of the ETF pie. The other 75% is basically going to fees that are less than 10 basis points. So if you're looking for revenue, not a lot of action is going to happen there. So largely the innovation is going to be for this slice of the pie. And that's what we're seeing. And now real quick, this has almost nothing to do with what I just talked about, except for the fact that it was a big issue and something we're watching next year as well. The S&P 500, we feel, probably took a hit to its brand, adding Tesla so late, delaying it, and reminding everybody that this index is run by a human committee. And it kind of proves there is no such thing as true passive. That's why we like to go with dirt cheap and shiny objects rather than active and passive. So the S&P still gets a lot of flows because those indexes and ETFs are very cheap. But look at how the S&P lagged other, quote, beta indexes, namely the Russell 1000 and a few others. And Qs, obviously, that's not quite beta. But this is a year in which it reminded us that, not all beta is the same. And the S&P lagged what would be considered straight beta by about 100 basis points because it added Tesla so late. And in the past 6 months, all the S&P 500 ETFs and indexes have seen outflows for the first time in a long time. You rarely see them see outflows. So we think some of this money could go over to the total market indexes like VTI, which has held Tesla for 10 years. You don't have to worry about when those stocks are getting added. So that's something to watch too, is this sort of battle for beta. That's a sort of a separate issue. But largely, I think much of the action is going to happen in this battle for the slice of non-beta cash, which again is about 30% of the inflows each year. So with that, that's what we're watching. If you need to reach out to us, here's our email, our Twitter handles. We interact with people over there too. And if you are interested in podcasts, I co-host one called Trillions on the ETF industry and highly recommend it. It's on iTunes. Thank you very much.
Hello, everyone. I'm Peter Grauer, the chairman of Bloomberg, and I am delighted to welcome everyone here today. Although we can't be together in person, an event like this reminds us of what connects us and the values we share, even at a distance. Now in its 6th year, the Bloomberg Gender Equality Index, or GEI, has been shedding light on a previously dark area of ESG reporting among public companies, gender-related practices and policies. And as more companies have come to recognize the business case for fostering an inclusive environment, the GEI has grown year over year. This year's index is larger than ever. 380 global companies spanning 11 sectors, headquartered across 44 countries and regions, have taken part. For the first time, companies domiciled in Indonesia and Bermuda are reporting gender-related data, and we're delighted to welcome some incredible new participants, including our good friends at BlackRock and NASDAQ. Not only are more companies disclosing data than ever before, but the quality of disclosure continues to improve. For example, GEI companies had a 94% disclosure score on average. And although we raised the threshold for inclusion in the 2021 index, we are still seeing record numbers of companies disclosing data. The past 12 months have been hard on everyone. And increasingly, we are seeing that the S in environmental social governance, ESG data, has become more important to companies than ever before. Firms that provide an inclusive environment, supporting work-life balance and flexible work arrangements, will eventually succeed in retaining a talented workforce and gain a competitive advantage in a business environment that has been significantly altered by COVID-19, possibly forever. I want to close by thanking companies that are committing to solving the important issue of gender equality by disclosing data on their efforts to support gender equality through policy development, representation, and transparency. Their efforts are creating accountability within their industries, collectively driving real change. I wish everyone a healthy and profitable 2021, and I'm looking forward to the rest of the program. And now I'd like to turn it over to Patricia Torres, Global Head of Sustainable Finance Solutions at Bloomberg, to provide some further insights into this year's GEI. Patricia?
Thank you, Peter. I'm happy to be here today to share with you some of the highlights from this year's index. As Peter mentioned, in today's virtual working world, it's more important than ever that companies maintain a strong corporate culture, as the decisions companies make today can drive progress on equality for years to come. This progress begins with the GEI. By using...
Okay, guys, we closed position, as you can see, on Euro at 121.14. Okay, so all of you who follow my trades, you should get profit and you should close your position, because at this point the momentum change and you never know what's going to happen. It might go one way, it might go to another way. According to our strategy, we just collected profit. Okay, speak to you later, guys.
Inclusive work environments, with 87% of companies included in the GEI providing flexible working hours. Second, these companies are working to close the gap through female leadership. On average, 29% of GEI members' boards are women, and more than half of the companies require a gender-diverse slate of candidates for management positions. Next, these companies are hiring more women than they are losing, and 69% have specific strategies for recruiting more women. These firms are also addressing equal pay, with 59% conducting a global gender-based compensation review and 40% publishing their global results by gender. And finally, they're investing in their local communities. 54% of firms sponsor programs educating women in science, technology, engineering, and mathematics, or STEM. As these numbers show, these firms are taking their commitment to gender equality seriously. And now you can hear directly from one of the GEI members. You can learn more about the GEI framework and 2021 insights on bloomberg.com/GEI. Thank you for your continued support, and please enjoy the event.
Hi, I'm Jackie Simmons, Senior Executive Editor for the Americas at Bloomberg. And joining me is Mindy Grossman, President and CEO of WW International, formerly known as Weight Watchers. So Mindy is a trailblazer in the consumer space when it comes to building and growing brands. She knows brands. She's worked for names from Nike to Polo, Ralph Lauren, Tommy Hilfiger, and many others, a real businesswoman in her own right. And as one of the 380 companies in the Gender Equality Index, or GEI, WW has been part of this for 2 years. And so I thought maybe we would start there. You know, one of the metrics where WW scores highest relative to its peers in the GEI is for inclusive culture. What's inclusive culture? That's everything like initiatives including benefits and parental leave. Mindy, we only have your data for 2019 for that metric. So I thought maybe you could tell us a little bit about what happened in 2020, a year when benefits and flexibility and parental leave were primordial to working parents and especially for working women.
Sure, Jackie, and great to be here. I think what's important is the core fundamental and acute reason that you really need to embrace diversity and inclusion at all levels of business is something that I've embraced throughout my entire career, whether it was starting Nike's first Women's Leadership Council, working on, with Catalyst on inclusion surveys, or in every company that I have joined or led, making that a core fundamental foundation of what's going to create business success. And I believe that those organizations that embraced it even that much more significantly in 2020 are going to accelerate their ability to attract talent, to be able to have greater business success and have greater innovation. And what we really did in 2020 was we invested more. Given the environment, there's nothing more important today than creating a culture that will attract talent, develop talent, and retain talent. And utilizing your listening skills to understand what's happening is really critical. But diversity is one thing, but creating a truly inclusive environment where people feel valued, where people can have, you and I were talking yesterday about the expression I like so much, you can have conversations that allow for productive discomfort because you have diversity at the table. The second thing that we've been very focused on is diversity at the board level as well as within the organization. So if you look at our board today, even compared to where it was 3 years ago, we have 6 men, 6 women, 2 Black women. My team is diverse, and that affects the entire organization of how inclusive people feel. And you brought up the issue that a lot of women in particular are facing throughout what has happened with COVID, with disruption of lives and families at home and kids not going to school. That division of work has really become tilted. And when you look at the recent numbers of, 2 million coming out of the workforce, that's a frightening statistic. And I think you saw the other day, actually yesterday, I was part of a group of 50 leaders, female leaders, who wrote a full-page letter in the New York Times to really talk about there truly needs to be a Marshall Plan for moms. And as employers, we have to support, but we also need the support to come from elsewhere, or we are going to lose progress on everything we've done to ensure diversity as a core element of business success.
Yeah. I mean, you kind of tipped into the next question, which is really about life in lockdown and all things pandemic. And, the impact of COVID on women in the workforce has been, a really harsh reality. Women accounted for the vast majority of jobs lost in December. But the data also show that the impact on female jobs that were lost happened where flexibility was not possible. And so how do you think about the challenge of retaining female staff as we all hopefully get vaccinated and start heading back into offices?
I think we're never going to go back to the way we used to work. At least I hope not. Fortunately for us, we were a pretty flexible workforce organization, very Zoom, Slack. We have a lot of product tech, et cetera. But we really felt that if we truly value talent and we trust talent, we have to give them the flexibility to do what they need to do as long as they feel confident in being able to do their job. And as we move forward, to your point, even with a vaccine, we're going to remain a very flexible, part remote workforce, but we'll all be more purposeful when we get together. And I think, giving talent the ability, right, to be able to manage what they need to do is part of how you build a culture that you're going to retain.
Sure, but we ran a lot of headlines the other day citing some finance professionals. They had some companies in the Wall Street space saying, you know what, the work from home is not sustainable. People need to get back into the office. They need to bump into each other at the water cooler. They need to be around other colleagues. I mean, how do you calibrate that with?
I am not saying that there is a need for interaction, right? I absolutely believe that. You want to be able to get in a room. You want to be able to have those conversations. You want to be able to have those offside, commentary. I think that's very important. What I'm saying is that to do that, we should be more purposeful. So think of the environment we come back to as almost part library where you come in and do your work, and part event and meeting space where you're coming together with, a reason and a purpose to be in that room. And I think people really want that. They want the ability to be able to have those conversations.
Got it. I mean, just going back to GEI for a second, I mean, your female leadership score was little change between 2018 and 2019. You were still above average, in the index. But, many people, we talked about this, assume a company like WW, whose business model holds a lot of appeal for women, will be, naturally tapped into issues around equity, both gender and demographic. So when you think about sort of a COVID economy and how that's exasperating inequities within demographics, including women, what are you hearing from CEOs, and especially male CEOs, about the urgency of narrowing that gap?
So I think it's critical. And I think those CEOs, whether they be male or female, who are enlightened enough to really realize that having a diverse team is going to give you greater business success. You're going to be able to have the conversations. You're going to get diverse point of views. You're going to attract more talent. All of that is critical. I think the other thing is the assumption, because you primarily service women, is you need all women, right? No, you still need diversity to get different perspectives. We're a global company. We need global diversity. We need, if you think of all the elements of diversity, even of our member base, age, race, gender, geography, life stage, all of those things. And you want to make sure that you have a seat at the table and you're taking into consideration everything you need for your business. And I think that is really more critical today than ever. And again, I said it earlier, don't think that if you want to attract talent, that's not something that's going to be looked at in a very significant way.
All right. I want to talk a little bit just about, again, in a COVID moment, I want to talk about WW's business model, because, COVID boosted demand for home fitness equipment and definitely fitness apps and all things digital. I admittedly have gone onto the App Store on my Apple phone and downloaded a couple of fitness apps. There's a lot out there. How do you stand out?
Yeah, so we have been, committed. And when we came out in 2018 with, our new mission and vision of truly democratizing wellness, and part of that was the significant investments in technology to have technology plus meaning help people live better connected lives and truly build an ecosystem of wellness, never abdicating our leading position in weight loss, but giving people a complete tool to help them build sustainable, healthy habits. And that is more important now than ever. And what we've seen, because we see behavior in real time, we see what's happening is people are doing what I call a radical reassessment of how they live, how they work, how they play, what they value, and how they spend. And health and wellness has kind of like the hierarchy of needs, has elevated significantly, and people are looking for what they can trust. Wellness is not a luxury anymore. It's a necessity, and we've certainly seen that during COVID. So for us, we've used this time to accelerate our investments and our innovation. So just in the last number of months, we launched My WW Plus, which is our newest innovation that completely personalizes your experience using AI, machine learning, and marries you to an experience that's right for you. We launched Digital 360, our newest membership tier that not only provides everything and those tools, but also is on demand 24/7 coaching, content built on community. And I think what people are looking for now is A, trust, B, value, but C, something that is going to be with them for their long-term journey. And we definitely see that's what people are looking for right now. So if you look at what we last reported, our digital business being very strong, now launching D360, and there was and still is part of our business that incorporates face-to-face as well. Obviously, we've had to move that to virtual workshops, and we were able to do that because of the investments we made in technology and all of the innovation. And to your point, people are still going to want, certain people are still going to want that face-to-face interaction, and we're going to be able to provide that to them.
I definitely want to come back to the innovation and the investments, but I have a question from the audience about some comments from our earlier part of discussion, which was about the unemployment numbers for women. This person says they're devastating. What can companies do to find those women who have left the workforce in 2020 and recruit them?
No, I think that's going to be very critical. And, you know, I know that I've had a number of conversations with other CEOs on, you know, how can we create forums to be able to identify and really understand. But I think the other thing that's important proactively is within our organizations, because, you know, we've had women leave the workforce because the workforce has narrowed, but we've also had a lot of women leave the workforce because of family issues and because not having the flexibility. So I think within our own organizations, we have to be proactive in being able to identify solutions, whether they be time solutions, financial solutions, support solutions, so we don't lose the talent that we need to have.
Right. I mean, here's another question, just in terms of accountability, you know, in terms of bringing in diverse talent and more women. When you have exchanges like, you know, NASDAQ, which are proposing to hold companies account in order to do business with them, you know, my question is that the role of the exchanges, or should companies be doing something differently themselves to find ways to hold each other to account?
So my answer is both, right? I think I'm a big fan of what Adina did, and, you know, obviously our board reflects that. But, you know, I do think that you have to be very purposeful and measurable. So, for example, when I was at Nike and we really had to identify how could we have greater gender representation, we did an inclusion survey, identified how we had to bring women together, but we also put in place, you could not fill an open position unless 50% of the qualified candidate pool was diverse. And then you had to hire, and then you had to measure, and then you had to incentivize your leadership on the diversity of their pipeline. And if it doesn't come from the CEO, it is not going to be embedded into the culture. And inclusion is a skill. And yes, you can have diversity, but you also have to work just as hard at inclusion. And so your board has to reflect that, your leadership team has to reflect that, and your culture has to reflect that.
That 50%, you know, candidate pool rule that you developed, you know, decades ago, is that something you use today within WW?
Yeah, we ensure diverse pools for all our roles. And, you know, it's our way of doing business, right? So, you know, it's embedded throughout the organization, which is how leadership is, you know, measured and how it's embraced. And I think it's of critical importance.
So, you know, with the few minutes we have left, I said I wanted to come back to the innovations and new products, you know, which you talked about, that, you know, spelled out nicely. But when you think about innovations and new products, are there opportunities, new opportunities in 2021 to partner with other firms in the wellness space, or even buy, you know, a rival in the digital, you know, product area?
So I'm a very big fan of partnerships, authentic partnerships, where together you're going to create greater impact than if you did it on your own. A great recent example is we announced, Sharon Leidy, who's the CEO, and I announced a partnership with Vitamin Shop. And it's not just a product partnership, but it's product experiences within their retail formats. And she's also partnered with us as part of the Healthy Living Coalition, where there's now 20 businesses in both the public and private sector that are really committed to closing the real disparity gap between access to healthy food, so around advocacy, action, and investment. So, you know, she and I like to say a great partnership is authentic and 1 + 1 = 10 if you can identify what you can really do together to have impact. And so, we look for those opportunities to be able to partner and, to your earlier point, at times acquire businesses that are going to help us accelerate our efforts.
Is there anything specific you're thinking about, in the next sort of 12 months?
Well, we're very focused right now on the diabetes space. We just brought in Dr. Adam Kaufman as our head of diabetes. We have a big focus on our new membership verticals to be able to provide more support, and a very big focus on personalization and really being able to make every journey individual to the unique person.
And when we look forward to more announcements there, really with just a minute and a half left, I want to quickly ask you about your subscriber numbers because they looked really good in Q3. You also added higher margin digital products. Revenue contracted. Some of that I think was probably owed to the studio business. Very quickly, Can you tell us a little bit about what that business is for people who aren't familiar, and what's the outlook for the studio activity?
Sure. Well, as you saw at the end of Q3, obviously with our studios closed and that being a higher business, there was some revenue pressure. But we were thrilled to end the quarter with 60% gross margins because of the high margins of our digital business and now D360 and what that flow through was. So we will continue, with a lot of the closures to just be able to maximize our digital platforms, but really continue to be able to build our subscriber base as effectively as possible.
I would be irresponsible to not ask the question about Oprah. One of the more prominent voices, not only for the firm and face of the firm, but she's on your board, an investor. Can you just tell us in the last 30 seconds, what can we expect from her contribution to WW in 2021?
Look, Oprah's been an incredible partner to me and to the organization, and she's a great example of kind of ultimate discretion and what she puts herself towards. I think everybody knows we did that incredible tour with Oprah at the beginning of 2020, 9 cities in 9 weeks. And then we also launched a significant virtual tour because right now galvanizing people to do the best for themselves is important. So look for things to come from us with Oprah.
Okay, and on that note, Mindy Grossman, thank you so much for your time. Thanks a lot.
Thank you so much, Jackie.
Thank you all for joining us for the second day of the year ahead. We hope you enjoyed these conversations. Thanks again to all of our speakers for a wonderful program. And thank you to our sponsors, Alex Partners and IBM. And most of all, thank you for being such an engaged audience. To rewatch any part of this event, you can come back to this website where the recordings will be uploaded. You can also access videos of all interviews on Bloomberg Live's YouTube page. The year ahead continues tomorrow, January 28th. You can check out our agenda on BloombergLive.com. We do hope you will join us again.
otherwise, in another crisis, it won't work.
Francis, I wonder what we'll hear from Jay Powell in terms of his message for lawmakers. In the past few months, we've really heard him say, hey, we've done what we can do from the perspective of monetary policy. Now that there is a new Congress in session, now there is a new president, what is the message that you think he's going to have for lawmakers to try to compel them to act on fiscal stimulus?
Well, he'll probably get questions about how much of this fiscal are you incorporating. Usually the Fed likes to see it actually deliver before it's incorporated into their comments. But we're going to hear the same thing we hear from all central bankers, which is please more fiscal. What I'd like to hear is whether Jay Powell can make some sort of comment about regulation that helps to, prevent bubbles from developing, or more focus on some of the other areas the central bank has been focused on: climate change, inequalities, housing. I mean, the things the Fed is looking at are really expanding beyond its inflation and employment. It would be good to get a sense of how he sees the central bank's role on those topics, which has traditionally been something more at play in Washington.
Right, and certainly something we've heard about from President Biden a lot this week. And I remember you and I on the last Fed meeting when we heard Jay Powell talk about climate change. That was one of the things that stood out for us. I want to pose a question to both of you, and Ira, maybe take it first. I mean, I am curious what line Jay Powell will walk when it comes to that $1.9 trillion stimulus plan. Do you think that we might hear words from his mouth that are going to be more supportive of a bigger stimulus package versus a smaller one? Because the press community, that's going to be a lot of the questioning. And I think, Francis, you brought it up, and I know some of our other team, Kathleen Hayes, saying that's what I want to know.
Yeah, I think he's going to say what he said before Congress a month or so ago, and that's that the fiscal stimulus is up to you, but it needs to be targeted. It should be, it should make sure that it affects the sectors of the economy that are hardest hit. So I think he'll continue with that rhetoric. There is a limit, I think, to what he's able to say, but he'll say it has to be big enough to spur the economy. It's not his job to give a precise number. But then he'll say, maybe he'll say like bigger is better. Like that's not out of the question that he says something like that. I don't think he will, but he might hint at that maybe in words that I'm sure he's tried to wordsmith the last couple of hours thinking about how to answer the many questions that he's likely to get on stimulus.
Yeah. Francis, what about your thoughts on that?
I'm going to this press conference thinking about one thing and one thing only. And I know it wasn't your question, but I'm just obsessed with this, which is how the heck is Powell going to get people to stop talking about tapering? It hasn't come up. He clearly doesn't want us talking about tapering, so maybe even bringing it up isn't a good idea. But he has to get this market to stop thinking about it. And one of the only ways he can do that is really come down super hard during the press conference. So, there's going to be questions about fiscal. There's going to be questions about GameStop, maybe put a different way. But what I really need to hear from him is, are you happy that Bostic raised tapering and that we're starting to think about it, or do you want us to put us aside? And my entire Fed view for the next 3 to 6 months is based on the tone of that commentary. That's what's really going to drive rates here.
So what else would you ask him?
Francis?
Oh,
Francis,
me personally?
Yeah.
Yeah, sure. So I have a whole list. I want to hear about taper topics. I want to hear about employment versus inflation. Convince markets that you really are doing average inflation targeting, because they clearly don't view that. I'd also love to hear how he views short-term downside risks versus medium-term outlook improving. Now, the statement actually took out the words short-term and medium-term, which I think are very interesting. I think they just want to give themselves some optionality. But how is he thinking about just how bad the next 2 months can be versus how much better 12 months from now should be? That's also going to put some stuff in here. And of course, we got lots of news about the ECB not being very excited about market pricing on the possibility of rate cuts today. I think they're talking down the euro. You might get a question or two on USD. He won't answer it, but I'd probably ask it anyway.
Yeah.
If I can, just to go on that, I think that near term and medium term is interesting, because I think that goes to the point that they're trying to get away from needing to answer the question like when will we taper or when are we going to hike rates. That's something that they just want to get out of the vernacular. I agree with that idea. I don't think you can though, because ultimately, like if you're trading a 5-year Treasury note, you have to have some kind of view on what short-term interest rates are going to be and going to average over the next 5 years. So the question is how he doesn't want to hand tie themselves by saying, look, we're not hiking until at least 2023. Like that would be the answer that would be as clear as anything. And you could always change that later. Like if the facts change and the economy's growing like gangbusters at the end of the year, you can change it. But that would be a massive signal. He won't say it, but that ultimately is the only kind of thing I think you could say to avoid the market continuing to question when are they going to taper, and then following on to that, when are they going to hike rates.
And I should point out one of the headlines we had earlier this morning, just after the open in New York, ECB officials said to see markets underestimating the rate cut odds. Hey, one thing I want to just pose to both of you as well. We got a great Bloomberg exclusive by a team of reporters here at Bloomberg, and it talks about the amount of debt, $19.5 trillion of global debt that has been added as a result of COVID-19. We're talking about government debt, corporate debt, add it all up together. It's all been done to avoid some kind of deep and lasting depression around the globe. Ira, let me ask you, we've had to do that. There's no doubt about it. And does that worry you at all, that amount of debt?
Yeah, well, it worries me only insofar as what happens when interest rates eventually, assuming they do, eventually do go up, and we have to have higher interest rates, and interest payments become a much larger and larger part of the government's budget, right? Because the governments are getting more and more hand-tied, and in the U.S. that's true because of things like Medicare, Social Security. That only leaves a little tiny bit, basically, of the total government expenditures basically to be allocated to everything else. And the challenge then is if interest payments get bigger and bigger and bigger, that reduces the flexibility of what Congress can do in the future. But to your point, I think it is something that had to be done, and probably more needs to be done. Is 1.9 trillion the right number? Maybe, maybe not. I think you could maybe target, do a 900 billion, a trillion now, and then if you need to do more later, you could still do more later.
So, Francis, come on in here. Based on your own and modeling your own expectations, when is a realistic time to think that interest rates could foreseeably actually go up?
I have the interest rate hike at 2024, but what I tell the teams I work with is, what I'm way more interested in is how high can interest rates actually go when we get to that normalization cycle. And my view is that exactly as Ira just laid out, because of high levels of debt, because these central banks are focused on issues beyond the traditional inflation mandate, they're probably not going very high. I think the terminal rate in the next hiking cycle is probably 2% or less. And for those of us who are long-term investors, it's not so much as it has second half of 2023 or first half of 2024. It's how high are these things going to go? I don't think very high.
Right, and you do wonder, it's level as well as how quickly they get there. Folks, thank you so much. Francis Donald, she's Global Chief Economist, Head of Macro Strategy at Manulife Investment Management, on the phone from Toronto. And our thanks to our own Ira Jersey. Actually, she was on the phone from Montreal. Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, on the phone from New Jersey. So just to reiterate, Fed maintaining monetary stimulus, citing a moderating recovery. Economy's path to depend significantly on vaccine progress. And Francis pointing out that was certainly something different from what we heard in the past. Bond buying continuing at $120 billion a month pace. We did see Treasury yields pretty much hold steady, dollar and stocks dipping slightly. So that's kind of it in a nutshell, and we're just seconds away from Jay Powell.
Yeah, Dow now down 1.6%, S&P 500 down the same, the NASDAQ down 1.75%.
All right, we do want to take you to Washington. We are expecting to hear from the Fed Chief Jay Powell in the first meeting, FOMC meeting of 2021. And as we said, going widely as expected.
At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we have taken forceful actions to provide relief and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to the economy. Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. The path of the economy continues to depend significantly on the course of the virus. A resurgence in recent months in COVID-19 cases, hospitalizations, and deaths is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, the pace of the recovery has moderated in recent months, with the weakness concentrated in the sectors of the economy most adversely affected by the resurgence of the virus and by greater social distancing. Household spending on services remains low, especially in sectors that typically require people to gather closely, including travel and hospitality. And household spending on goods has moderated, following earlier large gains. In contrast, the housing sector has more than fully recovered from the downturn, supported in part by low mortgage interest rates. Business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to federal stimulus payments and expanded unemployment benefits, which have provided essential support to many families and individuals. The recently enacted Coronavirus Response and Relief Act will provide additional support. Overall, economic activity remains below its level before the pandemic, and the path ahead remains highly uncertain. As with overall economic activity, the pace of improvement in the labor market has slowed in recent months. Employment fell by 140,000 in December, as continued gains in many industries were outweighed by significant losses in industries where the resurgence of the virus has weighed further on activity. In particular, the leisure and hospitality sector lost nearly 500,000 jobs, largely from restaurants and bars. The unemployment rate remained elevated at 6.7% in December, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower-wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices picked up over the summer, but have leveled out more recently. For those sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. While we should not underestimate the challenges we currently face, several developments point to an improved outlook for later this year. Sufficiently widespread vaccinations would enable us to put the pandemic behind us and return to more normal economic activities. In the meantime, continued observance of social distancing measures and wearing masks will help us reach that goal as soon as possible. Support from fiscal policy will help households and businesses weather the downturn, as well as limit lasting damage to the economy that could otherwise impede the recovery. In addition, as we have seen since last summer, the economy has proved more resilient than expected, in part reflecting the adaptability of households and businesses. Finally, monetary policy is playing a key role in supporting the recovery and will continue to do so. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Today, we unanimously reaffirmed our statement on longer-run goals and monetary policy strategy, as we typically do each January. As we say in that statement, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since last March has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. Our forward guidance for the federal funds rate, along with our balance sheet guidance, will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. Our guidance is outcome-based and ties the path of the federal funds rate and the balance sheet to progress toward reaching our employment and inflation goals. Thus, if progress toward our goals were to slow, the guidance would convey our intention to increase policy accommodation through a lower expected path of the federal funds rate and a higher expected path of the balance sheet. Overall, our interest rate and balance sheet tools are providing powerful support to the economy and will continue to do so. We've also taken actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We are committed to using our full range of tools to support the economy and to help assure that the recovery from this difficult period will be as robust as possible. Thank you. I look forward to your questions.
Thank you. Gina Smialek. Hi, Chair Powell. Gina Smialek from the New York Times. Thank you for taking our questions. I was hoping that you would first react to the wild ride that GameStop stock has had this week. And then secondarily, you and your colleagues have repeatedly made it clear that you really plan to use macroprudential tools as a first line of defense when it comes to financial stability risks, but your macroprudential tools primarily apply to the banks. I'm wondering what your plan is if you see some sort of large financial stability risk emanating from the non-bank financial sector in the coming months, especially as it relates to search for yield kind of activities. What do you see as the solution there? Thanks.
So on your first question, I don't want to comment on a particular company or day's market activity or things like that. It's just not really something that I would typically comment on. In terms of macroprudential policy tools, so as you know, no doubt, we rely on sort of always on through the cycle macroprudential policy tools, particularly the stress tests and also the elevated levels of liquidity and capital and also resolution planning that we impose on the largest financial institutions. We don't use time varying tests and tools as some other countries do, and we think it's a good approach because for us to use ones that are always on, because we don't really think we'd be successful in every case in picking the exact right time to intervene in markets. So